Hey there, everyone. Happy Tuesday, March 25th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny and actually quite warm. We're just over 70 degrees here in Redmond, Washington. Unseasonably warm. I've got the dress shirt, no sweater, rolled up sleeves. Like that's the temperature we're dealing with here. The market kind of heating up as well. Now, today ended up being more of a choppy sideways sort of digestion day after the rally that we experienced from the end of last week through a Monday session yesterday, which certainly was a decent move to the upside. Today, kind of stalling out a bit with the S&P just above 57.75. Now, what's interesting about that is consumer confidence came out earlier today. It wasn't great. As a matter of fact, it was arguably not good, and the market not caring a whole lot. One of the, I guess, key takeaways of my own experience over the last week or so is what should not be particularly encouraging data, like weaker consumer confidence, the market kind of shrugging it off and moving to the upside. So at some point, that usually ends poorly. Would be my assumption is that we are pricing in a little more optimism than is than the market really deserves. Now, having said that, we also have GDP coming out tomorrow or Thursday, I want to say. We also have the PCE data coming out later this week, which is the Fed's preferred inflation gauge. And so those sorts of numbers could certainly have market moving potential. I would have said the same thing about consumer confidence. Consumer confidence this morning basically implied all the things we're, arguably concerned about, or that the market has been going down because of the uncertainty around tariffs, because of the concerns about renewed inflation. All of that, I would argue, the confidence number earlier today sort of reinforced all of those things. However, the market pushing higher. Now, it wasn't all great, and you'll see in a moment 50-50 kind of a coin flip between which stocks, which sectors were higher or lower. So with that in mind, let's get to the market recap and see how things are actually playing out today. Again, I kind of label this a digestion day after we've had a couple good up days, pushing the S&P at or just above its 200-day moving average. We were due for kind of a digestion day where we don't really continue the trend, but more just kind of digest what we've experienced so far. S&P up 0.2%. That's not much. That's about 9 points for the S&P, closing just above 57.76. The NASDAQ composite up about 0.5%. The Dow basically flat for the day. Now, for much of the afternoon, kind of 12 Eastern to around 3:55 Eastern, the Dow is actually in the red, and just with a nice rally in the last 30 minutes, managed to eke out a slight, I'm talking super slight gain. 4 points higher on the Dow is pretty small. That's what, 0.01%. So that's not much. I would say in terms of the actual Dow movements. Let's see, mid caps and small caps both down. So the S&P 600 small cap index down 0.2%. We did talk about the death cross that's evident on the IWM chart. Also charts like NVIDIA and others. Spent a lot of time actually talking through some best practices and just my own experience using that particular crossover technique using the 50 and 200-day moving averages. So if you missed yesterday's episode, I would encourage you to review that one on our YouTube channel just to go through that toward the end. During the chart review, we talked about the death crosses on there. So for now, small caps actually following through to the downside through the course of the day. So nice upside rally into the close for the S&P and the Dow. Not so much on the smaller side of the ledger, continuing to go lower. The VIX continued to drift lower, about a third of a VIX point today. So we're just above 17, that is. So below 20, we're in a low volatility environment. Market's telling you things are okay according to volatility. As a reminder, my interview last week for the Market Misbehavior podcast with Jay Soloff and Investors Alley was awesome. All about volatility, all about the VIX, VIX futures, VIX term structure, how to interpret levels in the VIX, changes in the VIX. So please make sure you listen to that video. I learned a lot from that conversation. I hope you do as well. All right, looking at the other markets here, starting with the fixed income markets, you can see the 10-year point slightly lower. We're just about 4.3% there, 5-year point, we'll call it just above 4%. Long bond yield around 466, and no real change, to be honest with you, with the long bond yield. That's pretty consistent. 10-year and 5-year point drifting slightly lower. The TLT, which is a bond ETF, was literally no change. This was unch today. Now, it opened lower, right? So bonds opened lower. Midday, bonds are higher on the day. By the close, we came right back to the zero level. So in the afternoon, we saw stocks rallying and bonds rotating lower. So it just seems to keep reinforcing that inverse relationship, which is not all the time. Actually, plenty of times that stocks and bonds actually move together, but not recently. In the last 6 weeks or so, we've certainly seen a return to that inverse relationship, where when stocks are doing well, bonds are probably struggling, and vice versa. So today, bonds struggling into the close while stocks actually rallied. The dollar index essentially unchanged today. It did open lower. This is the UUP we're looking at. It traded higher through the course of the day, but no real significant change. I think I grabbed the chart of the dollar, though, potentially with a bit of a rounding, bullish rotation here. Also, the chart of crude oil, which we haven't looked at in a little while here. All right, looking at the commodity space, we can see the DBC, again, kind of a choppy day, but didn't end up directionally moving anywhere. This is why, to be honest with you, I think it's so important, certainly as a medium-term or long-term investor, to focus your time and attention on the closes, right? I mean, one of my mentors, Jeff Weiss, who's a fantastic technical analyst, kind of old school, pencil and paper, drawing trend lines type of analyst. He would always say during the day, that's noise. Like, let's see what actually happened from one close to the next. Let's see what happened from one Friday to the next Friday. That's why the weekly close is so important. And I think his comments along those lines were super helpful for me in terms of forming my own approach of thinking about how to understand the short-term dynamics, but thinking about how that fits into the longer-term trend, and don't make long-term decisions with short-term data. Make long-term decisions with long-term data. When in doubt, zoom out. So having said that, what's going on with some of these commodities? I would say generally we're seeing a nice improvement in the commodity space. I've seen a number of comments about like the new super cycle in commodities. I'll tell you, gold and silver, kind of the precious metals trade, pretty much already there. I mean, gold above $3,000 an ounce for the first time in history is pretty impressive. The GLD up another 0.4% today, and I do own GLD in terms of disclosures. The SLV, the silver ETF, up over 2%. Copper, 2.2% to the upside, we'll call it. Crude oil flat for the day. Natural gas prices were a little bit lower using these commodity ETFs that we're looking at. But one of the things we've been talking about here in the month of March is sort of a renewed upswing in some of the energy stocks. We'll see what sort of sustainable moves those have, because if you look at the energy sector, if you look at the XLE, it's kind of Exxon, Chevron, and then everything else. Exxon and Chevron are the two that have actually had a valid breakout recently. Most other energy stocks not really there, except for some random outliers, some random differing patterns. But the average kind of energy stock is still well below previous highs and really struggling to break out. I grabbed a chart. I want to say PSX was the one I grabbed. Grabbed one of those energy names to show, just as an example of a stock struggling at its 200-day. I think it was PSX. We'll see that in a minute. Cryptocurrencies, Bitcoin, again, kind of chopping around here as equities sort of stalled out here today. Crypto is kind of the same. Bitcoin, you can see, is threatening getting toward 89,000. We're currently around 88,200 as we go live with the show today. Ether prices about 0.5% lower. Kind of mixed results with the rest of these. Again, the chart of Bitcoin, I think, still has a lot to be desired in terms of a primary uptrend. You are seeing some signs of stability, seeing some lows start to be established. And I think the rotation we've seen in the last week may be one of the more encouraging developments we've seen since coming off of that all-time high around just over 108,000 earlier. All right. Looking at the 11 S&P sectors, again, almost a 50-50 split between up and down. Your top performers, communication services, the XLC, up 1.3%. Consumer discretionary, number 2, up 0.8%. Financials, number 3, up 0.6%. On the downside, utilities down 1.6%. Utility charts don't look great, and I'm generalizing an entire sector that way. You're seeing some of the defensive sectors like utilities, real estate, healthcare, consumer staples. Those are your bottom 4 sectors today. I think one of the defining moments of the last 6 weeks, or certainly one of the defining moments so far in 2025, has been the resurgence in defensive sectors, right? Sectors like utilities and real estate, which have been lagging for 2 years plus, all of a sudden start to improve on a relative basis in a way we've not seen since kind of July, August of last year, that last major pullback we saw in the S&P 500. This week, we're starting to see a deterioration in the performance of some of those defensive sectors as some of the growth sectors like the XLC and the XLY start to rally. I mean, the real question I think that we're all trying to get our heads around is this a counter trend move where some of these defensive sectors that have been doing well are starting to pull back and give back some of those gains? Some of the FANG sectors that were doing quite poorly since mid-February starting to bounce higher. I'm tending to think of this market as a counter trend move here over the last week. But the question is the sustainability of those gains going forward. Consumer confidence today did not do really anything to change the complexion of this recovery trade that we've seen here. We'll see if the additional data, GDP, PCE, all the acronyms coming out between now and the end of the year, or the end of the week, that is, excuse me. All right, so growth over value, value over defense is the general way I would observe the sectors in terms of what we saw today. Advancers versus decliners, sort of a very simple measure of daily breadth. We can see with the New York Composite Index, more down than up, right? It's around 56% decliners to 42% advancers. In the S&P, almost identical, 56 to 43%. The NASDAQ Composite a little worse, with 2/3 of the names down. Small caps the worst. 3 out of every 4 S&P 600 names were actually lower today. So the lower you got in the cap tiers, or the smaller you got in terms of the market cap, generally speaking, the worse that things went today. So overall, this was a distribution day. Now we've seen some big up days in terms of this data. We've seen 90%, 80%, 90% up days with some of these indexes here over the last week. So it's certainly been more of a positive complexion to short-term breadth. But today, keep in mind, while the S&P and the NASDAQ essentially were flat for the day, or the Dow certainly flat for the day, the breadth conditions were much more negative than the headline numbers would suggest. Worth noting, look at the market trend model. And again, I don't update these models formally until every Friday at the close. That's going back to my mentor, Jeff Weiss, reminding me to wait patiently for the end of the week and not draw too many excited conclusions midweek based on what I'm seeing, particularly for a longer term analysis like this. If Friday was today, though, the medium term the short term models for mid caps and small caps would actually turn positive. Now, there's a lot of game left. We've got Wednesday, Thursday, Friday session still, and the S&P's short-term model is actually very close and slightly moved above zero. It looked like at one point earlier today. So we'll see if that would happen, and if so, that kind of confirms, short-term bullish, medium-term bearish, long-term bullish. That configuration would basically mean a counter-trend rally within a cyclical downtrend and a secular long-term uptrend. So that's pretty much how this market feels to me right now. So I wouldn't be surprised if that's what the market trend model does on Friday. We'll keep track on this and see how things play out through the course of the week here. All right, looking at the Magnificent Seven and friends, and I did add Broadcom on there because it's another sort of mega cap tech name testing the 200-day. I just wanted to track all these together. Tesla up today 3.5%. Netflix number 2. Up 2.6%. Why do those stand out? Well, Tesla, because it's been probably the worst of these charts. Maybe Tesla and Microsoft having an arm wrestling match as to who can be the least awesome chart out of this group. But Tesla managing to have a pretty decent bounce here. Again, the question is all about sustainability for these severe bounces out of oversold conditions. One thing that I've learned, and the reason why I'm not just telling you these are great uptrends we all need to be buying, is because bear market rallies, I always say, are sudden, severe, and seductive. They're sudden in that there's no warning when all of a sudden you turn on a dime and have these pops. They're severe in that they tend to have a very accelerated slope. So the biggest up days you will ever see over time happen in bear markets, in cyclical bear markets, when these big snapback counter trend moves. And the third one is seductive. I think what allows a short-term bounce to continue is a lot of people get sucked in. There's a FOMO motivating that buy. There's a fear that you missed the bottom and you just want to, you want to get in before you miss any more of it. But the problem is when those fizzle out, everyone gets caught. Everyone that bought in gets caught on the wrong side. And that's when there can be that big wave down when everyone sort of panics and realizes, that was just the beginning of something worse. And again, I can't tell you that's definitely going to happen here because I don't know any more than you do. But I've seen it happen enough. I've seen that movie enough that I know this feels a lot like another movie I've seen many times in my career, where buying in that first jump off of an oversold condition is usually just not worth it. And it's better to be patient and wait for the market to, really confirm that we're in a recovery phase. And I haven't seen enough to sort of tell you that yet. All right, on the downside, only two of these names down. Broadcom, which I did mention, AVGO, down another 1.6%. Now, this is key because it's, trying to hold its 200-day moving average. And I think that's the open question for this basket of names, particularly a group of them that all tested that. We talked about on yesterday's show. You'd be amazed how many papers I have on my desk after just a week of doing things and not cleaning my desk. But yeah, yesterday we talked about Amazon, Tesla, Apple, Alphabet, NVIDIA, all testing their 200-day from below. Some of them already starting to break above, others not. Meta, Broadcom testing their 200-day from above, and we'll see if they're able to hold those levels. I mean, at the end of the week, at the end of the month, how many of these names are still above their 200-day moving average? I think that could be a really important tell for this market. NVIDIA down as well today. All righty, that'll do it for the market recap. Let's go to the market carpet, which is a heat map style visualization. A little more of a nuanced market carpet. Yesterday it was sort of all green with a limited random little bits that were red, but most things were kind of net positive. Today, a little more of a neutral day. And again, on a day like this, using this color scheme on stock charts, and again, the market carpet was upgraded early last year, I want to say, and I'm really, really happy with a lot of the changes that were made to this visualization. I like this color scheme personally, called vanilla, which means neutral is kind of vanilla beige. And for me, the big down moves in red, the big up days in green stand out. There are a lot of different color schemes, and I'm not going to tell you one is better than the other. I honestly don't care which one you use, as long as the one you use helps you identify things that are important. And for me, this seems to work, and that's why you got a lot of choices. And so this is how I'm sharing it with you. So a lot of things the average color today seems sort of neutral. And then you've got big up days like Tesla and Netflix and Palo Alto and CrowdStrike all kind of jump out at me, having big up days while the rest of the things are kind of neutral. But also the big down days, things like AbbVie and Merck in the healthcare sector. I mean, Merck's a rough chart, and I didn't grab this one, but I will just show it very quickly. Merck is one of those charts that's a great reminder that prices go down for a reason. Anytime I see a chart that's in a downtrend, I often get people asking me, questions basically getting to, should I be buying this new low? Should I buy things immediately after bouncing off of a new low, like here? And I always tell people, like, it's a nice bounce off of the low. That's great. But you have to remember that even if the primary trend is down, you're going to have these counter trend rallies that are good. If you're a swing trader, like, you should absolutely be trying to trade that move. I would be using something like a 5-day or 9-day RSI to try to identify that bottoming condition, maybe identify when we've hit a level where I might want to unwind that position. I have no problem with that approach as a swing trader. For me, though, trying to think a little bit longer and just thinking about what those swings mean in terms of the longer context, I still see this as a primary downtrend, right? As of today, rolling over yet again, we're making lower highs, lower lows. And I think that was the concern here, is really didn't, regain the December or January lows or highs. We're making another lower high. We're now below 2 downward sloping moving averages. This last rally, the RSI stalled out at 60. So it has all of those markings of a counter trend rally within a downtrend. So for me, that's still a pretty broken chart. And again, the problem with owning a chart like that today is if you own Merck, that means you don't own any of those other charts that are looking really good, right? You're not owning, I don't know, Stryker, which is a name I grabbed for later, just nice in a primary uptrend. You're not owning a Netflix, which is above 2 upward sloping moving averages. And so, again, there's an opportunity cost for being in charts that aren't good. I sign off every episode by saying it's always a good time to own good charts. And I guess the corollary to that, it's probably a really bad time to own bad charts, right? It's rarely a good time to own bad charts. So focus on the charts that are good. And if you can just do that consistently, find the good charts. If you're in a bad chart, get away from it. And if you're in a good chart, add more to it. That's the Peter Lynch methodology of pulling your weeds and watering your flowers, right? Nurturing the positions that are working, pulling out the ones that aren't working, getting them out of your garden, getting them out of your portfolio. That's how you grow a successful garden. That's arguably how you grow a successful portfolio as well. What else stands out here? I mean, utilities, real estate, kind of all neutral to red. Healthcare, a very kind of reddish tinge to that one. Consumer staples. So it's clearly the defensive sectors that are not getting a great particular setup here. And so again, while the defensive sectors have had a really good, improved relative strength configuration in 2025, I would say in the last week you're seeing a bit of a rotation down there. I'd be watching those to see if and when we get a nice improvement in the relative performance of the defensive sectors. For me, that would probably be a big check mark in the probably another big leg down kind of list if you have one of those. That's one that I would definitely be looking at. Final one would be Walmart. Walmart has had a big rotation lower. Broke out above $100 a share in February, broke back down below there. Now a pattern of lower highs and lower lows. Unfortunately, now we may be making a new swing low, continuing that pullback in some of the big box retailers that were absolutely lights out fantastic in 2024. All right, we're going to get to the chart review here in a moment, but I do want to remind you, by the way, I have a webcast coming up tomorrow on Wednesday, March 26th, 1 p.m. Eastern. You can sign up at marketmisbehavior.com/relative or just scan the QR codes that you see on your monitors. We will be talking about relative strength, that idea of looking at the relative performance of defensive sectors, the idea of focusing in a period of market uncertainty on areas of the market that are demonstrating positive relative strength. That is what I did working with big institutional investors. That is what I would encourage you to think more along the lines of in your own portfolios. Should be a fun conversation, should be great Q&A, and should be hopefully a lot of ideas of particular areas of the market to focus in on. Again, you go to marketmisbehavior.com/relative to sign up for that free event coming up tomorrow. You can scan the QR code as well. If you can't make it live, just make sure you sign up, and I will send out the replay to everyone that signed up, whether or not you were there. You're welcome to check out the replay and have some time reviewing the information. All right, let's get to the chart review. So we're going to go through a series of charts. I'll try to make time for a question or two at the end, and we'll call it a beautiful Tuesday. I want to go hiking today because it is such a gorgeous day, and it reminds me of like a summer day. And what often happens after I do this show is literally I can't turn things off quickly enough to throw on hiking boots, go about 2 miles away, drive quickly, or ride a bike to the trailhead. Is a beautiful waterfall we can get to. Benefit of living out in the country. The trail's probably a hot mess because it's been pretty wet here at the moment in recent weeks. So I don't know if that's going to be the play, but at least I'll walk the dog and get outside, get some fresh air here in a moment. I hope you could do the same wherever you're at. All right, looking at the daily chart of the S&P 500, again, a nice counter trend rally off of the 5,500 level. That was our downside objective. And again, lined up pretty well with that low a couple weeks ago. So a bounce off of that level makes sense in so many ways. When you have a counter trend bounce like that, I immediately look to where a rally could stall out. And it could be anywhere from the 38.2% Fibonacci level around 57.25, the 200-day moving average currently around 57.55, all the way up to 58.50, which was that line in the sand support level that we talked about here for many moons, and that finally broke going into the beginning of March. So I think we're kind of right about at that point where if this is a counter trend rally, this is where I would expect things to start to lighten up and start to roll over. Otherwise, we have to start thinking whether that's the appropriate label. So what would tell me that that's probably not the appropriate label for this market, and that this is a big V bottom and then ripping to the upside, which is possible. I think the S&P over 58.50 certainly starts that for me. The RSI pushing above 50, pushing above 60 on the daily chart, which would suggest an influx of new buyers, not just a rally, a short-term bounce, but something more significant, something more meaningful. improvements in breadth conditions. We have a chart of the at least one breadth indicator to share with you here in a moment. Improvements in breadth, things like that. That again, this so far is the classic playbook for that bounce after the first big wave down. And again, look back to like January of 2022 to get an idea of how this could play out and get a lot worse. And the short answer is we don't get above those levels that I just mentioned, right? What I'm talking about are those things that probably would indicate the end of that counter trend rally. If we get much above there, it doesn't look a lot like 2022 anymore. And I think you have to take that way of thinking maybe off of our plate and just accept the fact that the market's recovering a lot more than certainly I would expect as reasonable, given a very questionable macro conditions right about now. Volume. I actually had a question on volume yesterday, and I didn't get a chance to answer it on the show. I was reviewing later and putting some questions into the mailbag for this Friday's episode. And I did come across a question specifically yesterday on volume. So I wanted to share this chart with you today. Worth noting here, today Tuesday and yesterday Monday, volume not great. And the volume today on the SPY kind of a lot lower than what we saw. Now, Friday was quad witching day, so you kind of had a lot of volume occurring after that. Monday and Tuesday, much, much lower. So we're having a bit of a bounce, but the volume's not great. If you take that Friday session, which is a bit of an anomaly, you can see that the trend in volume has been generally down over the last 2 weeks. And so that's not encouraging. Now, the Chaikin money flow was negative for much of that period because we were having heavier volume on those days we were closing near the lows. Now we're actually having closes near the highs. And so as a result, the Chaikin money flow as of yesterday's close did actually break above the zero level. So something to watch here today. That actually might have been with today's close that we really broke above there to the level that you see now. That's certainly something to watch there. Another sort of, what would tell you this is starting to be a better recovery than you expect. The Chaikin money flow remaining above zero would be one of those other indicators I would keep an eye on for sure. The breadth, though, again, still pretty negative, right? We saw today, even though we had a slight update for the major benchmarks, it wasn't a broad advance, right? This was more key sectors with a lot of weight, like consumer discretionary, like communication services, having enough of an update that it was able to pull the benchmarks higher. But generally, more stocks were down than up. We still have about a 50-50 split of stocks in the S&P above or below their 200-day moving average. This is sort of a long-term breadth indicator here, right? The percent of S&P names above their 200-day. The S&P just trying to get above its 200-day. A number of the FANG stocks right about at that point. We covered that in detail on yesterday's show on Stock Charts TV. I went through that in a lot more detail. But we'll see if it's able to hold. And I would say the bull case from here means this indicator really has to get above 50% and stay there. For now, it's not great. It's still more of in a bearish configuration. All right, we'll look over at the VIX. Again, we've had a continued downtrend in the VIX. Pretty much every day for the last 2 weeks, except for one, has had a lower low. That is something I'm definitely noticing right about now as the VIX continues to drift lower. So we had the big sell-off here mid-February to mid-March. VIX spikes up to the upper 20s. Again, great time to interview Jay Soloff, and I was really excited to really dig through that period. So again, hopefully that helps you make sense of what we've observed with the VIX. But as the VIX is drifting lower, again, that's when I think about my release valve, like what's the button that you hit that tells you, okay, this downtrend is now reinitiating. VIX back above 20 would be one of those things that I look for. I kind of have a perpetual alert for when the VIX is below 20 to just see when it breaks above 20. I would encourage you to have one of those as well and just see when it happens. It's not if, but it's when. And I don't know if it would be tomorrow or a week from now or a month from now, but at some point the volatility will spike, probably when investors get more nervous and volatility increases. For now, we're having a nice counter trend rally on lower volatility. That's pretty much how that is playing out. All right, two charts here to talk about commodities and currencies. First, we'll start in the currency space with the dollar index. I just want to show that if you look at the September 24 low, connect that to the January 2025 high right around 110, you can see we bounced off of the 38.2% retracement level, now down to the 61.8% retracement level. We actually broke below it right around 104 earlier this month. We've bounced off of it a couple times from below, but this week actually pushing above there. And I'm wondering if that's the beginning of an upside recovery in the dollar. We were oversold as we broke below the 61.8% level. I think more to prove to see if that's a new reversal, but non-U.S. markets have been absolutely, fantastically strong year to date, certainly relative to the U.S. and on an absolute basis. Charts like Italy, like France, like Germany, the UK, Switzerland, strong charts, and even Poland. Strong charts getting stronger generally. Weaker dollar has certainly not hurt that trade at all. When you look at the U.S. listed ETFs that play those markets, you'll see that effect as well. So an upside reversal in the dollar could be an interesting change of character, something to monitor for sure. I know with my premium members at Market Misbehavior at our monthly chart review coming up about a week out, we will certainly be digging into the dollar chart. Also, did a little work on the crude oil chart. I just wanted to share with you here, and this is, it's just looking at the potential rotation we've seen. While the dollar is hooking higher, you're also seeing crude oil prices hook higher as well. This is the crude oil future we're looking at, bounced from around $65 a barrel up to $69, which is where we closed today. Now, I actually first drew this purple trend line back here in the fourth quarter of 2023. Took it from the original high there, connected it to a subsequent high that lined up pretty well with the high in December of 23. And then you can see we finally broke above there in January of 2024. Ended up being a nice recovery. I took that trend line and just copied it, same slope, and just started on the major peak there. And you can see it actually lines up pretty well. These are like the same trend line. I just copied and moved it over. And then the break of that trend line was a pretty good buy signal. You also notice if I look at Fibonacci retracements, take the height here, and then we can see 38.2% ended up being an initial target, but really 61.8% was the eventual upside target. We got a little bit above there before making a new swing lower. Same trend line, same breakout. 61.8% retracement is right about there. Again, we drifted slightly above there, a couple dollars a barrel before rotating lower. This one, the trend line did not map as well. It was a much shallower trend line, but you can see using the Fibonacci retracements, once we made a low, we traded just above 61.8%, also the 200-day, and that was kind of the rotation lower. So that analog, that pattern that I've observed a couple times is fresh in my mind. This is literally the same trend line with the same slope as these two, connected from the high. Look at how it lines up with some of these subsequent peaks. We've broken out above there in the last week. Does that mean an upside target around $74, $75 a barrel? Maybe. And if so, that would mean energy stocks are actually a decent place to be for the first time in forever. I mean, it's been a while since energy has looked anything but good. So this is not a fundamental commentary on crude oil or any of the geopolitical issues around oil producing regions. It's just to look at the chart and recognizing the fact that we're actually seeing a change, which has led to previous gains that have been pretty decent. I'm going to continue to monitor that chart and encourage you to do the same. All right, we'll finish with some individual stocks. I'll take a question or two. We'll call it a day. Meta bouncing off of its 200-day moving average. We highlighted that, over the last week or so, holding the 200-day currently around 574. Yesterday, a gap higher. Today, kind of a doji candle, which is something interesting. Doji candle looks kind of like a cross on the chart, open and close around the same level. Usually represents short-term indecision. So if we're bouncing into a doji, it tells you the next 1 to 3 bars are probably lower. But Meta for now is in kind of that no man's land between the 50 and the 200-day moving average. That means where we're at right now is neutral. Breaking above 650 would be super bullish and suggest a retest of 740, which would be a nice upside follow through. A break of the 200-day says we need to dust off some downside targets. So something to keep an eye on. Amazon gapping above its 200-day yesterday, which is right at a big round number, $200 a share. Today, a nice follow through as well. And I think that's one of the key items to look for with the FANG stocks. I mean, I don't think the S&P or the NASDAQ have any chance of meaningful advances beyond what we've seen so far unless charts like this can get above their 200-day and hold them. So for now, Meta and Amazon definitely checking that box. Look at Tesla actually trading above its 200-day moving average and closing above it. Now, before we get too excited, I do have to point out Tesla looks like what's called a hanging man candle. Hanging man candle kind of looks like a hammer, and if it was happened during a downtrend, you'd call it a hammer candle. But when it happens in an uptrend, you call it a hanging man. So think of that as the head and the big lower body. So you have a hanging man candle as we test the 200-day. Candle charts would tell you the next 1 to 3 bars are probably down in that scenario. So seeing on a couple of these like Meta and Tesla kind of short-term reversal signals, but again, the bounce is certainly real over the last 3 sessions. We keep closing near the highs. The chicken money flow is improving as a result. The RSI is pushing above 50. It's getting better and better. A trend line here is still holding, and it's kind of right about in that 315, 320 range. And maybe that's the level that would convince me that we're no longer going down. But I remain a Tesla skeptic from a technical perspective. And full disclosure, I do own a Tesla, which I'm enjoying a great deal. Bought it earlier this year. It's a Model 3. Kind of good and kind of fun and zippy. And the full self-driving is super fun. That is awesome. Once you get over the fear of having the car drive itself, it's actually quite convenient. All right, looking at NVIDIA. So NVIDIA, you look at Meta, you look at Amazon, breaking above the 200-day nice uptrends. NVIDIA just certainly looks like an outlier in the fact that it's in a clear downtrend channel of lower highs and lower lows. And I'm not seeing enough to change that. So for me on the chart of NVIDIA, and I'm going to jump in and draw a trend line here real quick. I mean, I think the trend line to watch is this one right here, right? So this is kind of the pace of the decline, right? This is kind of your downtrend channel of lower highs and lower lows. We've bounced off and I drew this really quickly just for time, but kind of bouncing off the lower end of that channel. It means you have upside to the upper end of the channel, and it's still technically within a pretty consistent downtrend phase, I would argue. At some point that probably changes, but I'm not seeing the change just yet, which is why I think the chart of NVIDIA still wait and see mode. Sorry about that. There we go. So something to watch. The RSI literally dead even at 50. And so while other names have regained their 200-day, I think NVIDIA and others like it, like Microsoft, definitely have not reestablished a foothold above the 200-day. Stryker, I just want to point out that like NVIDIA just stands out because it's in this nice uptrend of higher highs and higher lows. Stryker stands out to me as well, right? I mean, this is a healthcare name, medical equipment, for now bouncing off of the 200-day moving average. This chart breaks below its 200-day. It's not a great chart anymore, but for now it's holding it. And I think that's why charts like this deserve the benefit of the doubt until proven otherwise. 200-day currently around 362. That's not too far below current levels. It's about $10 below current levels. Problem in the utility sector. This is Dominion Energy, ticker D. I don't know if you've looked at it very often, but we are breaking below the 200-day moving average today. This is after holding the 200-day December, January, February, March. Today, we're actually breaking below the 200-day moving average for the first time since March of 2024. So it's been a nice solid year above the 200-day. We're starting to rotate lower. And I think utilities in general, again, having this short-term distribution pattern, which is concerning. The relative strength is what's so helpful to watch with defensive areas of the market because they have a decent yield. These are fairly low volatility, fairly defensive plays. So if and when a chart like Dominion starts to look pretty good again, that for me would make me a little concerned about the broader market environments, because that means people think Dominion is a good bet, which means other things are probably not a good bet just yet. Talked about the rally in crude oil. And again, I think there might be something there. We'll continue to watch it. Charts like PSX for me are a wait and see. This is probably what I'd call a potential complex head and shoulders pattern. It's kind of a bunch of left shoulders, a big head in the middle, and one right shoulder. So it's not a perfect head and shoulders bottom yet. I don't think I would label it that way because it looks kind of off from that. But I would say, look at how many times we've failed to get above the 200-day moving average just in the last 8 months, which means at some point we start to run higher. And that's where I think a chart like this, like PSX above 130, is a really good chart, I would say. And maybe that things like that happen, and I would be more confident in that kind of crude oil thesis I was sharing with you earlier in the show. Hey, let's finish with a couple charts showing quite a bit of encouragement. PSX kind of wait and see mode. I would say GM not in wait and see mode anymore, right? If you draw a trend line from the November high to the January high, you can see we just broke above it this week. On Monday's session, we gapped above it. We're trading up again, and the RSI is pushing above 60. That is a sign of a stock that has been in a distribution phase, now more in an accumulation phase. This is one of those sort of actionable charts that I see has further upside, potentially to retest the November peak, but certainly, a higher low would really complete that bullish rotation. But for now, I think a lot to be excited about. And hey, let's celebrate stocks like Take-Two making a new 52-week closing high today, a new all-time high on a closing basis today, closing just below $218 a share. So stocks are out there, charts are out there showing strength. If you're not finding them, I would dust off your scans, focus on scanning for stocks in constructive patterns. This chart that I'm just sharing with you, I found in a scan I created earlier today for stocks above their 50 and 200-day moving averages, and just looking for uptrends based on moving average configurations. Really, really easy to do, and really helpful list to review. You find names like this that are in uptrends, and generally speaking, as I've mentioned, it's always a good time to own good charts. So let's keep looking for good charts. All right, we'll take a question or two, and then we'll be done. Let's see. Bull Bear Jeff, thanks as always for watching, my friend. And you said VIX to a 15 print would be a good spot to short markets. I'm not going to agree or disagree with your trading suggestion there, but I would tell you you're hitting on what I think is really helpful with the VIX. I mean, the problem with the VIX is there's no guarantee that when we get to 15 that we can't just keep going to 13 or 12 or 8. All of those are theoretically possible. Now, what are the chances of the VIX getting all the way down to 8? I would say remote at this point, although possible, right? Possible, but very, very unlikely. What is more likely, and I would tend to agree, is if you're looking for where this kind of rally stalls out, looking for bottoms in the VIX and using that as a potential downside target. VIX down to around 15, maybe that's where you have a potential signal of the end of this short-term rally before rotation lower. I don't have a problem with that. I have trouble making a trade based purely on the VIX. Changes in the VIX tell me to look at the chart of the S&P or the Qs or whatever I'm looking at and analyze those from a technical perspective. However, I get your point, and I don't disagree with you in terms of thinking about 15. And again, previous rallies have stalled out around that level. I think the market has memory. A lot of people looking at the VIX here, probably more than usual. And I think that's a fair thing to review. Let's see. LinkedIn. Someone watching on LinkedIn, I appreciate you so much doing so. On SPX, sounds to me like an ABC retracement, currently a B wave before a C wave crash, like target 5200. Thanks for watching on LinkedIn. I appreciate it. You may be right, and that's my first answer is possible. I actually reached out to Jeff Huge, who's one of my favorite Ellioticians. See if I can get him on the podcast here. Hopefully, we'll be able to do that very soon. If you have other Elliott Wave aficionados whose work that you like and you think they do a great job, drop a comment. Let me know. I'm looking for some Elliott Wave-minded people to just comment on what we've seen so far, because I would agree it's been in a big initial move down, and this is certainly a bounce higher. So could this be wave A, wave B? And why that's helpful is because the way that Elliott Wave kind of works, particularly in this kind of environment, and apologize to I'm not a big Elliott Wave person, but I've had to study it so deeply for the CMT, so I know enough. If this is wave A, and then you have a big wave B, and let's say wave B ends around 58.50, then, and I'm seeing where you're getting your 5,200 target, right? If we end today, or if we end up at 58.50, that's your downside target, kind of in the 5,200 to 5,250 range. That would make sense. And that would be a classic A, B, C correction, at which point it would suggest a new impulse move to the upside. That's definitely possible. And it's one of the things that I think is interesting about Elliott Wave is using this first two waves, you can project where that third wave may go. Again, kind of interested to see some others and who look at that way more often than I do to see how they are thinking about the particular dynamics that we've seen here. So again, if you have any ideas or suggestions of who would be good to bring on and any other guests you think would be helpful to interview, I'm all ears, always looking for some people to talk to on the Market Misbehavior podcast. That'll do it for today. I want to thank you guys so much for joining me on Facebook, LinkedIn, YouTube, and X. I appreciate you so much doing so. And thanks so much for asking questions as well. Any of the questions we didn't get to, we'll put in the mailbag And we'll spend Friday's episode with a brief market recap and then answering some of those fantastic questions during the week. For Market Misbehavior, I'm Dave Keller. Enjoy the wonderful weather, I hope, wherever you're at. And remember, it's always a good time to own good charts. Have a good night, folks.